Welcome to The Explainer. Today, we're unpacking a fascinating and honestly kind of terrifying topic in modern digital markets. We're looking at exactly how these extreme DeFi yields are manufactured, and more importantly, the tactical strategies you absolutely need to survive a digital bank run. If you're looking to understand the hidden mechanics of today's market and protect your own portfolio, you are in the exact right place. So let's just dive right into it.
Now, this is the billion-dollar question, isn't it? Is crypto just one giant, highly leveraged casino, or is it literally the future of finance? Well, the reality is, it's really a tale of two entirely different worlds operating under the exact same roof. And to really grasp what's happening out there and figure out how to safeguard your capital, we need to look closely at this massive divide in the industry.
Here's our roadmap for this explainer. We're going to start by looking at these two futures of finance. Then, we'll break down the extreme yield machine, examine the anatomy of a DPEG, spot the on-chain warning signs, and finally, we'll arm you with a concrete defense protocol. All right, let's get moving.
Kicking things off with Section 1, two futures of finance, and the split personality that's completely defining the crypto ecosystem right now.
So there are two completely different philosophies clashing in the market today. On one side, you've got what we call the wild frontier. This is the space dominated by extreme volatility, murky reserves, and massive leverage loops. It is highly speculative. But then, on the flip side, you have the regulated bridge. This model is all about strict regulatory compliance, audited security like SOC2 reports, and super conservative risk management. The regulated bridge isn't trying to chase overnight gains. It's about building a scalable, resilient system designed to actually integrate with traditional finance.
And the power of that conservative approach really boils down to just one number, 47%. That is the massive average loan-to-value cushion being used over in the regulated model. Think about what that means. Because they maintain this incredible buffer, meaning for every dollar lent, there are over $2 securing it, less than 1% of their loans were forced into liquidation during a recent 30% market crash. Less than 1%. So while the wild frontier was dealing with absolute chaos and frozen funds, the regulated side, they just experienced business as usual. It's a massive difference.
Let's move over to Section 2, the extreme yield machine. We are going to step right into the wild frontier and see exactly how those eye-popping returns are actually manufactured.
Now, to understand the yield, we first have to understand the asset. We're talking about synthetic dollars. The whole point of a synthetic dollar is to maintain a stable value, right? But here's the catch. Unlike your traditional stablecoins, it is not backed one-to-one by cash just sitting in a regular bank account. Instead, it's backed by an over-collateralized reserve of assets. We're talking things like dividend-bearing preferred shares, for example, the STRC token. Basically, this transforms off-chain corporate dividends into on-chain programmable yield.
But here's where it gets crazy. How on earth do we get to numbers like 64% APY? The base asset, STRC, pays an annualized dividend of 11.5%. Which is great, but DeFi traders are somehow engineering yields all the way up to 64%. How is that math even remotely possible? Well, it all comes down to financial leverage and a very complex ecosystem.
Let's break down this Bayesian chain of leverage step by step because it's wild. First, a user starts with that STRC token, which gets them that 11.5% yield. Second, they wrap it through a protocol like APX to create the synthetic dollar, APXUSD. Third, they take that new token over to Pendle Finance to slice up the yield into fixed and floating components. And finally, step 4, this is the real kicker, they take those assets to Morpho and they start looping their loans. They deposit collateral, borrow USDC at low rates, use that borrowed USDC to buy more collateral, and then just repeat the process. This looping mechanism acts like a massive financial amplifier, cranking that baseline 11.5% all the way up to an explosive 64%.
But, as you probably know, there's no free lunch. The crucial takeaway is captured perfectly right here. When someone offers a higher interest rate, it's because they're much more likely to not pay you back. It's classic traditional finance logic, but it absolutely applies here. When you see a radically higher interest rate, it's because there is a significantly higher probability of total loss. And that brings us directly to the inherent dangers of stacking all these DeFi risks.
Which leads us perfectly into Section 3. The anatomy of a DPEG. What actually happens when these incredibly lucrative structures start to crack?
Analysts are actually measuring these hidden systemic risks incredibly methodically right now. Take the Ferris Safety Grades methodology, for example. It scores stablecoins from A+ down to F across 4 distinct dimensions. First, liquidity. This measures if you can actually exit your position during a full-blown panic. Then resilience, which tests the asset's ability to absorb sudden shocks.
Decentralization looks at control and governance risks. And finally, dependency. This one is the hidden killer. It simulates contagion. If a coin relies on another token as collateral, and that upstream token fails, the dependency metric is what catches that hidden systemic fragility.
And guys, that contagion risk, it is very, very real. Remember STRC, the foundational collateral for our earlier example? It's inherently volatile. In fact, its quasi-peg failed twice recently. It dropped to $90.52 back in November 2025, and then hit $93.10 in February 2026. You have to remember, that entire 64% yield tower is built right on top of this single asset. If STRC drops, it drags down the exchange rates across that entire daisy chain. Yield accruals have to pause, and those highly leveraged loops get dangerously close to forced liquidations. It's literally a house of cards.
So how do we spot the collapse before it happens? Let's transition into Section 4, spotting the warning signs. Because in the 2026 machine economy, a depeg doesn't happen slowly, it is essentially instantaneous.
Before we can spot the signs, we have to categorize the threat. Centralized risks involve literal fiat bank runs or regulatory freezes that affect the real-world custodians holding the actual cash. Synthetic risks, on the other hand, are a totally different beast. We're talking about negative funding spirals, where the cost to maintain your hedge suddenly exceeds your yield, or exchange-level smart contract hacks. Knowing exactly which assets you hold tells you which specific failure point you need to be watching.
Now, here are the literal on-chain smoke signals you absolutely need to monitor. First up, CEX-DEX price divergence. If a centralized exchange shows $1, but a decentralized exchange like Uniswap is showing 98 cents, liquidity is quietly fleeing. Pay attention to that. Second, if an issuer suddenly spikes their redemptions fees or straight up pauses withdrawals, exit immediately. Do not wait. Third, check the curve pool imbalances. For instance, if one stablecoin suddenly makes up more than 70% of the three pool, it means the smart money is aggressively dumping that specific asset.
All right, that brings us to our final section, the defense protocol. This is your tactical, step-by-step guide to actually protecting your capital during a digital bank run. If you see any of those warning signs flashing, you do not sit around and wait to see what happens. You execute this three-step emergency exit. Step 1, instantly swap to a flight to quality asset. Whatever you do, do not try to cash out to fiat. It simply takes too long. Swap to a highly liquid alternative stablecoin or a major crypto asset with zero issuer risk. Step 2, use an aggregator like Helix. In a market panic, extreme slippage can easily destroy 10% of your portfolio in a blink. Aggregators route your trade through all available liquidity pools to protect your capital. Step 3, move those secured funds over to a regulated haven that complies with frameworks like the EU's MiCA or the US Genius Act. Get it to safety.
Let's look at how this all builds into a practical toolkit for 2026. You need to have this specific infrastructure ready to go before a crisis actually hits. For an emergency swap where you need no accounts and an instant exit, a tool like ChangeNow is absolutely critical. For regulated storage where you have 100% reserve visibility, platforms like Bybit Wealth offer a solid safe harbor. Having an active account on MXC ensures you have access to the deepest alt-stable liquidity pools, just in case your primary venue freezes up. And finally, keep an eye on unusual activity with a whale tracker like Unusual Whales. This lets you spot those massive, large-scale institutional exits way before retail catches on. Remember, professionals don't build this infrastructure during a panic. They prepare it completely beforehand.
We've seen how incredible yields are engineered out on the wild frontier, and we've explored the much more conservative, durable foundations of the regulated bridge. As this industry matures, that gap is only getting wider and wider. So I'm going to leave you with this thought to reflect on. Knowing the underlying mechanics and understanding the real systemic risks, which side of the crypto divide are you building your wealth on? Thanks so much for joining me for this explainer, and as always, keep learning.